Welcome, ladies and gentlemen, to this afternoon's webinar sponsored by SunGard and looking at portfolio margining in a multi-asset trading environment. Before we kick off, I would just like to introduce our panelists for the day. Joining us here in London is Philippe Ramkvist-Henry, who is Head of Cross-Asset Risk Solutions at SunGard Front Arena, and Andrew Ross, who is European Head of Clearing at Morgan Stanley. Joining us remotely is Rebecca Healy, a Senior Analyst at TABB Group, and I'm Will Mitting, the publisher of FOW Group. So today we're going to be talking about margin efficiency in a multi-asset trading environment. Clearly, as clients search for alpha in more and more distant fields, it creates complexities within the brokerage. So we're going to be exploring that issue today and looking at how brokerages can overcome those challenges and adapt their systems to meet their client demands. So we're going to kick off with a presentation by Rebecca Healy at TABB Group, who's going to discuss what her research tells her about how clients are increasingly looking for multi-asset solutions and the challenges that poses. Rebecca, over to you.
Thank you, Will. Good afternoon, everyone. So, yes, as Will rightly pointed out, I think the biggest challenge for the buy side at the moment is the never-ending search for alpha that they have currently. And we've got some slides just to look at some of the changes that we see happening in the asset management industry. And the first slide that we've got here is basically, as automation is spreading through the asset classes, that's actually giving the buy side an opportunity to start looking more further afield. If they have everything at their fingertips, if it's all electronically traded, it's a lot easier for them to switch in and out of asset classes as they become available. And as such, although it has been a long time coming, a lot on the buy side now are starting to see a shift internally where they are actively looking to trade new products electronically. Now, this was a slide where we spoke to market participants last year, and we spoke to global heads of buy side dealing desks. And you can see here that 43% were looking to trade fixed income products electronically next year. And what's also starting to happen is you're seeing the heads of those dealing desks that were perhaps looking after just the equity product in the past are now being asked, if not to trade directly different asset classes on their desk, but certainly to oversee right from fixed income products through to FX and other emerging markets. And part of the issues that this creates for the industry is as people are looking further afield and they're switching into different asset classes, the actual investment decision alone is no longer just picking up the phone and saying, I'd like to buy some copper, or, I need to sell some silver. Even for classes that are not seen as traditional e-trading classes, a lot of data absorption that has to happen from so many different areas of the organization in order to be able to make the trading decision. So the slide I've got up here, I was actually talking to a head of a metals dealing house who's based out in Singapore. And he was explaining to me now that the level of information that they need to get, whether it's market data or fundamental data, they've got to include currencies. They have to absorb all that information, then feed it into their systems. They've got to feed it into their risk management systems in order to be able to understand, is this the right call? Is this the right decision that I need to make for my end investors today? And a lot of this is being driven by end investors and the fiduciary responsibility to not only be able to deliver best execution to your own clients, but also to stay ahead of the game. A lot of people were talking about it's becoming increasingly difficult not only to win mandates, but to maintain mandates. And you can only do that by demonstrating that you are delivering what your clients are looking for. And a lot of that will involve the absorption of more data. So we've seen a greater appetite for people to trade electronically, a greater appetite for the absorption of data. But it's this shift now between the different asset classes and this sort of multi-asset aspect. Again, long talked about. I know that many clients have been looking at this for a number of years, but they've still fought that sort of siloed mentality, which perhaps Andy would be able to talk about a little bit later in the presentation. The sort of siloed mentality of the sell side has made it difficult for them to make that leap in the way that they would have liked. But people are anticipating, and we saw the fixed income slide earlier, and this is more on the derivative side of fixed income. Again, another asset class that hasn't typically been traded electronically, but people are trying to find ways and methods that they can do that. And it's more also about their ability to be able to control the risk themselves, and rather than sort of hand over either execution or management of risk to someone else, they're wanting to have greater control of it in-house. The bottom line that a lot of this is due to regulation, and there is a regulatory push to push more products onto exchange, as we are all well aware. But I think there has been a lot of chatter and a lot of noise over the last couple of years about, will MiFID II ever come off? Will this actually happen the way that the regulators would hope for? And it's clear that the dust is now settling, and we are going to be facing a completely new regime almost in 2017 that people have to start making preparations for now. Not only is it sort of MiFID II, but we've also obviously had the US regulation, but people are having to change their processes and change their ways of working. So one of the things that I thought was quite interesting is when we looked a couple of years ago in talking to people about OTC derivatives trading, for example, and we spoke to the front office, and they were very much, well, we quite like the way we do business at the moment. There's no real reason for us to shift from voice. But actually, it's the back office requirements. It's this sort of the management of risk. It's the reporting functionalities. All of this has to be done in such a you can't sort of wait to send a fax anymore. All that information has to be at people's fingertips in order for them to be able to direct their resources where they need to be at any given time. And in order to do that, the whole process has to be electronic. So that, again, it's this shift from back to front. And maybe in the past we've had a level of investment and resources spent on the front office, but actually what we need now is sort of the risk management, the portfolio management. All of that aspect is driving new systems and processes that we haven't necessarily seen previously. And again, this slide here, which talks about the risk analytics and the collateral optimization, we've heard a lot about the collateral optimization, again, over sort of like the last 18 months, but it's trying to look at how brokers can provide their end clients with that cutting edge now. And it is more about helping your clients achieve the best, use what they have to optimize what they have and to make sure that they have got that effective solution. And a lot of that was down to regulatory reform, as we've discussed, but it's providing that cutting edge that people are looking for, particularly in risk analytics and margin efficiency tools. It's not necessarily about posting margin everywhere that you can. It's more making sure that you post what you can and where you need to post it. But again, it is an efficiency tool, and I think that's what people were talking more and more about, is resources are constrained. They want to expand overseas. They want to look into different areas, but they need to be able to do it more effectively. And in order to do that, there is this sort of new partnership relationship that they need to have with their brokers, and use, again, like I said, the tools that they have available to them, but in a much more efficient manner. Again, going back to one of the comments that I made earlier about sort of the OTC derivative space, where we saw that need for sort of back office processes moving into the front office. Again, with fixed income, it's a very similar story, where people are saying that in order to be able to trade any particular product, they need to be aware of their sort of traditional risk analysis. The element that would have taken place in the back office is now coming very much to the forefront before they actually hit the button, before they actually trade, exactly in line with the metal slide that we showed right at the beginning. They have to be aware of what their risk is up front in order to be able to trade. And whilst this may seem logical, a lot of the processes that happened in the back office now must be front and center before people trade. And that previously people wouldn't have had the tools. So again, it goes on to the next level, which is talking about the visualization and the data aggregation. Whichever way you look, whether you're looking at it from a regulatory perspective, from a risk management perspective, from a fiduciary perspective, or just a plain vanilla economic perspective of wanting to make sure you get the most bang for your buck, all of this is drawing together to say that without efficient data analytics, without the efficient risk management, and without having that ahead of your trade rather than as almost like an afterthought, that's really what is going to distinguish clients between those that will just scrape through and those that will build successful businesses based on that fiduciary, not only a fiduciary need, but also how end investors are becoming much more astute in terms of understanding which asset managers they can work with, who they can partner with in order to make sure that those mandates grow. We talked about this sort of the need for data, and all of this is putting extreme constraints on people's systems. And again, it goes back to this streamlining of data and the ability to get the information from whichever area within your organization into the right, to where it needs to be. And that creates new challenges for people. And again, talking about the sort of the post-trade aspect, having to move into the front office, and this sort of, you can no longer have this siloed approach. It has to be the data agility and moving from one asset class to another, whether you're looking at margin, whether you're looking at any other aspect. It's about using the resources that you have available to you in a much more streamlined fashion. And that requires people to have the data sets in a centralized source. It also requires the ability for people, you can't operate siloed business models anymore in the same ways that you have been able to in the past, because you need to get what you have in sort of A to B. And without that, the way of a sort of holistic overview, particularly when it comes to risk management, to be able to see where your pain points are in any given area and then maneuver those resources to that particular area to resolve your problem. This, again, is changing people's appetite and approach to how, not only how they manage risk, but the sort of the back office systems and processes overall, are moving that again much more into to the front office. So the sort of final slide that I have for you today is just how that is also changing people's approach to looking at risk management and just the visualization of it. And it has to be much more sort of tangible and instantaneous for people to be able to interact in the timely manner. So this whole sort of raw data aspect and people sort of poring over Excel spreadsheets, and this is a completely different agenda, and how people choose to interact with their data in order to be able to make it much more meaningful this is where you're starting to see that shift from raw data into more analytics, and then takes it onto a whole different dimension of sort of exploration data. And actually, you know, if I placed my margin here, what would this mean? Would I be able to invest in this particular place? So it's turning it into a much more of a two-way conversation that will then take it on to the next level in terms of people being able to manage the risk and manage their data in a much more effective manner. So those were some of the sort of the key points that I had just to start us off in terms of the conversation. But I think the bottom line that I would like to stress throughout all of this is the one factor that people, it doesn't seem to matter who you speak to, whether it's boutique asset manager to buy-side institutional manager to a broker. This is much more about getting more from less, being much more sort of cost efficient and operationally efficient with what you have available to you. You know, the room for fat has gone, and we're in very sort of lean times. People have to be agile and adept in how they deal with the resources that are available to them at any given time. And that's going to push more demands on technology, but it's also going to push more demands in terms of data and analytics, real time, in order to be able to manage risk pre and post trade more effectively. So, Will, those were just a few of my thoughts around the topic.
That's great. Thank you very much for that, Rebecca. That's certainly introduced a lot of the key themes that we're going to be running through over the next 40 minutes. Before I ask Andy for his response to some of the headline themes that were raised there, I just want to put a vote out to the audience. So on your screen now, if you're watching this, you'll see a question come up. Please select your answer, and then we'll review the answers shortly. So, Andy, we've heard a lot there about breaking down silos, changing business models internally to meet that client demand and streamline your processes in the wake of regulation. How are you at Morgan Stanley and banks generally adapting business models to meet multi-asset demands?
So, good afternoon, everybody. Hi. It's a great question. It's one that we've spent a lot of time internally talking about and thinking about. Have we got the right structure? Are we organized in the right way to service our clients? And we think about this through the lens of servicing our clients, and we think about this as being in the right shape and having the right commitment, technology, process, people, organization to do the best thing for our clients that we can. So what Morgan Stanley did a couple of years ago is rationalize all of its clearing businesses together. We put them into our prime brokerage business. The prime brokerage business, Morgan Stanley's the biggest on the street. Clearly, I would argue the best. And we moved in our listed clearing business, our OTC clearing business, and our FX prime brokerage business, and we put all of those together under a consolidated service banner. And then you get to the question, so we kind of try to break down that silo mentality, and then within listed derivatives, we would look at a commodity product or a fixed income product or an equity product. We view that as a cross-asset class product, where the simplification that clients are looking for is a consistency of process around ability to trade with an exchange traded product. They almost don't care whether it's copper or fixed income rates futures or S&P minis. They just want to know that it will clear and that they have a way of processing the margin and so on and so forth. So actually, I think that Rebecca's absolutely right that one of the challenges that we've had to tackle, and we feel we've done successfully, is break down some of those silos and give a real client-facing approach to the business. So, but that's only the first answer to the question. The second answer to the question is that clearing businesses cannot be everything to all people. And so whether that is because an exchange is no longer deemed to be a QCCP, a qualified CCP, and the capital required against that exchange would be enormous. The regulatory requirement to offer multiple segregation models for every market clearly has a cost about being in every market. You have more complexity to manage. And fundamentally, the impact of the prudential regulation in terms of the amount of capital that we have to hold as a business through classic, as it were, RWA style Basel 1, 2, or 3 models, and you tend to have floors, which is why I mentioned all of the Basel models, and more recently, a supplementary leverage ratio. And there's some very perverse elements within the supplementary leverage ratio, such as the more collateral you take from a client, theoretically the less risky you are, but from a supplementary leverage ratio, the more balance sheets from a leverage ratio you've used. So there are clearly a number of challenges within that environment that means that how Morgan Stanley responds is we remain committed to servicing our clients, and we remain committed to servicing our key clients with a full understanding and knowledge of those businesses and those economic challenges. But it clearly has an impact and will have an impact on pricing, and it clearly has an impact on whether you can be everything to everyone. And I think the reality is that you will not be everything to everyone. And for markets where there is smaller volume, where there is esoteric demand, I think that it is hard for universal banks to offer that general course of action on every exchange. We will not join every exchange and offer every product to every client.
Sure. Thanks, Anderson. A wide-ranging answer there, and we'll certainly pick up on some of those points, such as the leverage ratio in particular later on. But just to take the first point you made about breaking down the silos, you talked about how it's done from a team perspective, but operationally, it's obviously quite a huge challenge. Technically, it's a huge challenge. What were the main stumbling points that you came across when you went through that process of trying to create a homogenized offering?
So I think I'll look at this for a second through the lens of OTC clearing, if I may. And we looked at OTC clearing at Morgan Stanley and said, well, we could push this down our futures infrastructure. And as it happens at Morgan Stanley, we mainly use our own futures infrastructure, in-house built. But we thought, well, we could push it down the futures infrastructure. And we thought, no, that's not the right thing for us to do. We don't want to do that. And why do we not want to do that? Because we talked to our clients. And our client said, I don't want to consider an OTC cleared product a future. I want to know the complexity of all of the individual fields that exist within an interest rate swap or a CDS or an NDF. And I want to understand that complexity, and I want you to be able to tell me about it. So within our methodology, we said, well, we need to be able to process this through infrastructure which is absolutely aligned to our futures business. We built that internally to do so. But then what we did is we said, right, well, we want our margin calls. We want our statements, our reporting, our online tools, our real-time evaluation of what clients will have to pay as margin to be available consistently, whether that is FX, whether that is listed, or whether that is OTC. And so we tried to choose, we built through the lens of what will make our clients easier. And we have the flexibility and deliberately made the choice to build this through our own internal architecture so that we ultimately could offer what we consider as the best-in-class service to our clients. And so you don't need to worry if it's a commodity future, an OTC, or FX. At the end of the day, I will send you the file in the same way. I will send you the margin call in the same way. You can have all of that granular data broken down into little bits and pieces underlying that for your requirements. And we can give you that data in whatever means you like, electronically, by paper. I just can't do carrier pigeon yet.
Anyways, interstate commerce. Philippe, from your perspective, you deal with a lot of varied brokerages. Morgan Stanley is clearly a pioneer in many respects in this field. From your clients, what stage are people generally at in terms of this goal of a holistic single offering?
I think a lot of the clients we're talking to, they're in the stage of trying to merge, to break down these silos that exist within the firms. And it is the trends that Andy's talking about are coming from the back office, and the people I work with are more on the front office side, and they want to leverage these changes to offer better services to their clients. So exactly what you're saying is they want to have margins for all asset classes in the same way presented. They want to have the risk figures across their full portfolio, and traders they need to know their clients. It's a lot about knowing their clients to assess risk, knowing their risks, the profitability of their different clients. So knowing all of the aspects of the portfolio, the risk, the revenues is something that we see is happening within brokerages.
And that full picture is becoming a more complex picture. One of the second points you made, Andy, about how you can't be everything to everyone. It's a good point, I think, and certainly what you're saying out there with a lot of brokerages looking to specialise. But at the same time, you've got this fragmentation of liquidity. You've got new venues springing up everywhere. You've got sets, more asset classes coming onto electronic platforms, which creates far more complexity than perhaps existed, certainly on the exchange-traded electronic platform side. How are you sitting in terms of that development, and how does that impact on what you said before?
So there are two ways to answer that question. The first way is to look at that as a very negative construct, and it's a lot of money and it's a lot of time and it's very difficult, and you have to manage that through a structured regulatory process and environment. So clearly that is one lens to look it through. There is a lot of validity and merit in that. But the lens I prefer to look at that through is subtly different. In that, and again, let's take a new environment, and Rebecca touched on this in terms of the fixed income derivative trading. And maybe you could apply this equally in fixed income trading. But it's like fixed income derivative trading, we have all of these sets come up. The fact that there are 15 sets, or whatever the number is actually really beneficial to me, because my clients don't want to sit there with 15 screens on their desktop to try and get best execution. They want someone who will help them manage that complexity. So how do we help manage that complexity? We have an online trading tool that effectively allows us to aggregate some elements of that liquidity and show it to clients. And so clearly that is, early days for us, but the fact that we have a significant degree of complexity in the market is actually beneficial in some ways to cementing our relationship with clients, because we become I guess, to Philippe's point, a little bit of a guide and a manager, because people want to understand, and they don't want to understand all this complexity. They just want to be able to live through it, and their job is not to understand there are 23 different places to get the liquidity. Their job is to understand, I really like a 2-10 steepener in dollars. And so our job is to help them execute the 2-10 steepener in dollars in line with their best execution and fiduciary duties that Rebecca highlighted earlier on.
Andrew, I was just going to say that's right on the money, just in terms of it's almost how we're, in some senses, we are actually going full circle. And this is something that we're seeing in the equity world as well, is that, actually finding that liquidity, you do need a partner, but it's how people are choosing to do it. So instead of historically in the past, you might have got on the phone and spoken to your broker and done a voice trade, it's actually, you still need the technology and you need the electronic, but because the market has become so complex, you can't do it all on your own. And it is that level of partnering or having trusted partners that is becoming just as important as it ever was, but in a completely different environment, that you need the technology and you need to be able to demonstrate through data, through analytics, that you are actually doing your job and delivering what you need to be delivering for your own clients. I had one question for you though, just in terms of sort of future proofing. How much are you seeing clients sort of almost like playing around in terms of moving, sort of preempting investment decisions by actually sort of trying to look at the risk profiles? Is that becoming much more prevalent pre-trade rather than post-trade?
We provide an online tool that allows people to assess how much margin that they will need to fund to do a trade, and we also provide a real-time limits monitoring tool so that people can see how much of their available limit they have beforehand. And both of those tools are used significantly within our toolkit, but not by everybody. So I would say that it has become a focus, but it is not yet mainstream.
So would you say it's sort of one of the things that you're seeing an increase in? Or, I mean, is that a recent development, or would you say that there's those individuals that have, that's what they always have done? Or would you say that you're starting to see it creep into the mainstream?
I don't know.
It's interesting because it's just in terms of the conversations that we have with people, they're starting to realise that they've actually got to deliver more in terms, again, it goes back to sort of the end clients and the fiduciary responsibility, that they actually need to look further afield than perhaps they have done in the past.
Can I comment, Rebecca? Because what we see in our conversations with clients is when they're making this move, this silo breakdown into the front office, we see that this new markets, they're replicating some of the patterns from equity markets, and therefore we see clients wanting to use similar type of technologies for these new markets. Like we see the central limit order book popping up for new asset classes alongside with RFQ and dealer platforms, and we have the fragmentation was mentioned about the CEF. How do I find my liquidity? How do I aggregate? How do I find my best counterparty? And also then the pre-trade risk. Am I allowed to trade? As things move from voice to push of a button, you want those electronic tools to help you automatically assess if you're able to trade. And so you see sort of smart order routers for these type of assets, and you see also new type of algorithms that trade these new type of asset classes, working more with a more theoretical pricing model rather than the market price model that you see these equity smart order routers are doing.
Yeah, who would have thought it? Smart order routers in fixed income. It's amazing just how quickly things have moved in the last couple of years, actually.
Yeah, from our perspective, we can sort of 10 to 15 years of development in the equity markets occurring over 3 to 4 in the fixed income market. So it's certainly there. But I think, to finish, the last point I'd make, Will, on your question, about complexity, in some ways, it actually makes the franchise, for all of the reasons we've just talked about with partnerships, but also understanding and managing that complexity, it makes the franchise of the bank worth a lot more. It's like the barrier to entry as an unintended consequences of the regulation has just increased. The number of people who can do the servicing to clients in this space is small, and the work of people such as SunGard to help others to break into bits and do bits, I think is an important development in terms of increasing access to liquidity and available services. But from our perspective as a bank, it's very clear that being a big clearer is a very difficult business to get into. Being a partner around electronic trading is a very difficult business to get into. And once you've built those relationships, you're going to have to continue to work with your clients, listen to them, and invest to continue to support that business.
Okay. Before we move on to looking at the capital requirements and risk in a bit more detail, we just wanted to look at the poll we pushed out a few minutes ago, and what is the most important remedy to the current challenges in brokerage. Reducing the cost of ownership and offering portfolio margining to clients were the top 2 results, followed by improving execution and raising fees, and nobody, funnily enough, thought reducing fees was the answer to the current challenge. So if I could ask the audience just to close the box now, currently on their screens, and then we'll push out a new poll. This is on looking at how you aggregate risks. But so while you're voting on that, I just want to turn to the capital requirements that you mentioned. Obviously, you've got the Basel III, which I think everyone's familiar with, the RWA, but now there's SLR. Challenge is becoming increasingly discussed. How is that changing how you view clients? We hear about people being told that they've got to go elsewhere because they don't bring enough business in to justify the balance sheet requirements that they have. How are you changing your model internally?
So we've been and remain committed to being a clearer and across OTC and listed derivatives, and we continue to partner with our key clients to win additional business. But we have always priced that business in a way that we view as sustainable, in a way that we view as honest, and we've been very upfront about what we consider the costs associated with that business to be. And ultimately, do I think that SLR means that prices will go up? Yes. Do we review our clients on a holistic basis about key partner clients for the firm and doing adjacent businesses? Yes, we do. And I think that if there were people who own shares in Morgan Stanley, you would hope that I was saying exactly those things. And we run this business from a very commercial way, but we do that not just looking at a standalone silo of say, listed derivatives. We would look at that as to what the adjacencies that client has associated with that business. But ultimately, you can't run a business that loses money, and you can't run a business that doesn't make a return on capital. So there are significant challenges within that business that we and others will have to overcome. I would say that Morgan Stanley's position in this is particularly good because we've already had that very candid conversations with clients about where we will take the business on, and we have lost business on price because we won't go to levels that other people will, and that's fine. But we won't run that because we frankly will get to our capital floor.
But isn't this a conversation that every single firm must be having? You know, it goes back to sort of the efficiency question, doesn't it? And making sure, you know, everybody at the end of the day needs to be in it to make some money because nobody's operating as a charity. But I think to your point is that clients are having to make hard decisions about the partnerships that they create. But equally, there's new partnerships that are emerging, whether that is with third-party vendors, whether that's with different brokers. I think it's almost like everybody's changing their partners around the dance floor, but actually building longer-term relationships that they feel are beneficial to both parties. And the sort of the ability to use technology to help you do that, I think, is going to be critical to underpin the basis of that, because it goes back to being able to manage what you have efficiently internally. Would you agree?
I would, and I think that's right. I think that's spot on, and I think that's a great point. And I think the story from our perspective is one of, I suspect that, you know, I know that other peers, I've heard other people in public forums, the FOW conference last week in Poland, well, you know, people spoke about pricing having to go up, you know, from peers that were on the panel. It was like, it is a universally acknowledged statement that people make. But I think your partnership point, Rebecca, is exactly right. And where we try and get to is to optimize by technology, by market, by other means within the pricing and the way we approach integrating with clients to minimize SLR and to maximize return in an open way with them, with our partner clients. But I think you're right. It's all about picking those people who are in this for the long haul and who are going to be there and are committed to invest over the next 5 years.
Yeah.
Sure.
Yeah.
And to come on to really the headline of what we're talking about today, we've discussed a lot of the challenges and a lot of the operational changes that banks are undergoing. And I think one thing that's really come across is the need for greater efficiency with margin and the need for a more holistic view of risk across all silos. Philippe, obviously that's a mantra that SunGard have recognised for some time. What's your current approach to it, and in terms of realising these pre-trade risk efficiencies and low latency? How are you working to help clients do that?
Yeah, we're working with several clients in the front office, trying to realize the things that were previously only visible, sort of T+1. We're trying to move it all the way up to the low latency trading part of the business. So if you offer cross margining, for example, that you can offer it already at pre-order time for the clients, ultimately trying to make it possible for sell sides to offer trading to a cheaper price, looking at collateral, and also being able to offer services on top of what the cross-margining services that are offered, for example, by clearers. If you use multiple clearers, and if you're in some places you're also a member, to be able to offer to your clients that service of cross-margining across all of the asset classes, regardless what you're trading, and maybe then having a service of margin financing instead to cover that change of model that you have. And we see the first thing that clients are approaching, the first problem is that they are often working in a very fragmented landscape, not only across asset classes but also across systems. They have several systems. They might have even multiple systems for the same asset class, even for the same market. We see that clients, they have good risk view per system or per asset class, but they don't in real time have views of what's my client doing right now in real time, to be able to advise clients on, for example, where's my credit line, how's my collateral, what would be an optimal hedge for me for this overnight position, for example. That part of the infrastructure is something that we see clients moving into with the help of SunGard.
Mm-hmm. But technically that must be a huge lift to go from how people have been operating for many years, different systems that have evolved with totally different path dependencies and others. So where do you start in that process?
It might sound like a huge thing, but I think this conversation just proves that it's something that is happening regardless if SunGard wants to sell it or not. Because the market is moving in this direction, and clients, the sell-side clients, they acknowledge this, and they want to be one of the parties that remain in the marketplace. Their clients are demanding better services, lower collateral commitments, so they have to move into this space. And since we see across back, middle and front office this change is happening, it's not something that is just happening within one part of the organization, but you see the whole organization is moving towards this type of change.
So just before we move on to the cross-margining, I just want to have a look at the poll results. You have a single point where you aggregate risks across assets, markets and systems, and we're dealing with a rather sophisticated audience here that most people in fact do. Nobody's interested in it. A few people don't have it but are looking to implement it. And then we have some that managed in real time and some in real time and pre-trade. So before we move on to talking about the cross-margining, I just want to ask if the brokers on the line, if they currently offer it to clients. So that's the poll that's going out now. So margin efficiencies through cross-margining, obviously collateral optimization is a concept that's been around for some time now, and systems have been out to achieve that very effectively for a while. Cross-margining, there were some concerns people have about how far you can go before it increases risk. Andy, I know you've got a view on that.
Yeah, so we offer cross-margining, as you would expect a prime broker to do, and we've got people live at CME in the US doing futures versus OTC, and we're live on Eurex in Europe as well. The story though is, when can you cross-margin? And what was interesting to me is that someone showed me a graph the other week, which was Manchester United football results versus S&P down days. And the correlation was 0.8. And so the reality is Manchester United losing coincided with the S&P going down the next day. Now on like 4
last year then, when they lost every week.
And so the point is that just because something is correlated doesn't mean that it's actually causally linked. And so how we view cross-product margining is that if we have two products, which is, say, a US Treasury versus an OTC, well, I could liquidate that as a package. So I could either liquidate that via my own spreading engine, or I could liquidate that because I know what that risk is. The problem with a portfolio margining that is many different types of asset classes together, you could get to a significantly lower number. But at the time of default, those correlations can break down. As a person who owns ultimately the counterparty risk, you have to go and exit every single leg that you've put into your portfolio margin. And if at the end of the day that number is too low, you end up with a loss. So there are places where it absolutely makes sense to offer portfolio margining to clients, but our test at Morgan Stanley has been where we could liquidate the offsetting trades as a package. Then it makes sense to offer portfolio margining, swaps versus underlyings, equity swaps versus underlyings, OTC rates versus listed, but not gold versus equities, for instance.
Yeah, I totally agree, and it's sort of the way cross margin and margin has been done. It's been in the hands of the exchanges and the CCPs previously, and what we're trying to do is to put it in the hands of the brokers to offer these cross margin opportunities. And naturally, you need to have full visibility and transparency into what the margins you're actually posting on the exchanges as well, and managing that gap that you're taking on, which is, although your model may say, just as Andy says, that this looks fine, there's no risk, it's the same underlying asset, it's the perfect correlation. It might not actually be there when things break down. And when things break down, these models sometimes that we use are not applicable anyway, like a VAR model, it's at 95% of the cases, but it's not on the 95th day, which is the problem. It's the 100th day, which is the Black Monday. So you have to be careful when you mention cross-margining. It's not that number which is measuring your risk. That number is measuring a sort of liquidation risk that you have. You have to measure other aspects of your portfolio as well. You have to really know your client. You have to have good due diligence against your clients. You have to know what's the strategies they're working. How do their typically overnight position look? What assets are they trading? What types of scenarios should I be doing? Is span enough? Is VAR enough? Should I add on like steepening, flattening interest rates scenarios on top of the margining? The margin is just one number we're looking at. You need to be looking at the relevant numbers for your customer, and therefore you need to know your customers, so you need to have the numbers in front of you.
Philippe, it's more like what previously went before was almost like two-dimensional, whereas this is 3D. And it's a very sort of free-flowing conversation. You know, it's not like somebody sort of saying the box-ticking exercise where I've done my job, I've done my due diligence, and I've run my numbers. It's almost, you know, it has to be that two-way conversation. I think, Andy, it goes back to what we were talking about earlier about it being a partnership rather than just a product that one party sells to the other. It's that two-way conversation. In fact, even a three-way conversation if you're looking at end client, yourselves as a broker, and then SunGard providing the service in the middle.
There is one other thing on portfolio margining that we speak about a lot with our clients is where do the assets go to after you've done portfolio margining? So if you know, and I think that one of the points that Philippe made was really clear. So some of the listed markets in Europe, for instance, are on a net basis. So we post X amount of money to the CCP. If we've got 5 clients are long, 5 clients are short, I'll post the net of that to Eurex. I'll have asked each of those individual clients for their gross amount of margin, and again, fine. But where does that difference sit? Well, currently where that difference sits at Morgan Stanley is in the segregated accounts where it takes UK client money protection. But that understanding, I think, and that transparency is a very important tool that clients, I think, would like to understand more about. And as we move to individual segregated accounts or gross omnibus family level accounts, within the clearing world in Europe. I think the ability to want to understand this margining numbers and where my assets are and what risk they are, to Rebecca's point, becomes much more of a detailed level conversation, much more three-dimensional. It's not I tick my box. It's so where actually are there and what happens if the music stops and who's taking what risk?
I agree.
Violent agreement already.
Yes. We had an audience question actually on the portfolio margin within CCPs, the segregation, so we'll come on to that shortly. But Philippe, from a technology perspective, clearly, we talked about the operational processes that banks have to go through to achieve this. In terms of the low latency risk aggregation, how does that then ultimately feed into the margin calculators in the product, specifically in the product that you're going to be bringing out?
So our product, it basically does what your current back office that we saw that most of the clients already have, that they aggregate across system, across asset classes into a single margin. And what we do is that we feed this into our pre-trade engine in real time. So as soon as this value is updated, we feed this into the pre-trade engine. And you can view it in the simplest form as a kill switch, saying, is this client trading within its limits? And the pre-trade engine itself just looks at what's the exposure this individual order is posing, and it will sort of accept or reject the order based on those premises. And if by doing it this way, we can at microsecond level still do validation of orders. We can do these blunt sort of checks that are standard in the market today, like gross value traded and fat fingers and basic short limit checks. But we can also check exactly down to what has this client been doing across other systems in other assets, and should it be affecting what he's doing on this market with this order right now.
In real time.
In real time. Yeah, so there's a small lag, but it's on a millisecond level between what happens in one system before it's reflected into the pre-trade engine.
It's amazing that a millisecond is considered a lag. But that's where we are. So before we get on to the segregation, I just want to look at the results of the last poll question. Are you looking to offer cross-margining to your clients? We've got a split, 42% already offering it, 42% looking to offer it in the near future, and 17% of people currently aren't offering it. So clearly there is a lot of potential there to increase efficiencies in terms of what you can offer your clients. Just going to ask the final poll question now, which is looking at how people manage pre-trade risk today. So if I just click there, so now you should see that poll just coming in front of you, so please feel free to vote on that. So for the last 5 minutes, we'll take some questions. So if you do have any questions from the audience, please type them into the box on your screen. If you can't see the box, you close the poll and it should come up. Andy, client fund segregation. So the question is, how many of your clients are genuinely interested in individually segregated account?
Many. So the question is for clients, and this goes back to, can you be everything to all people? But if you're trading a global market, so you're trading US and Japan and Hong Kong and European markets, individual segregated accounts are perhaps an added complication that you don't really need over and above your protections that you already have via client money. And actually client money protections are in some ways beneficial because you don't have any transfer risk associated with those positions that go into a segregated funds, go into a segregated bank account and are paid from a segregated bank account. So, but that said, there are a number of other clients who are very focused on European funds who trade a lot of European products, who want to take absolutely what they perceive as the best risk management choice that they can, which is an individually segregated account, which maximizes their ability to port trades away and minimizes to the greatest possible extent the chance that any collateral that they've posted is liquidated. And clearly with insurance companies and clearly with pension funds where the collateral posted is part of the long-term hedge of the portfolio, then that is a significant issue. And, I can clearly see how a broker going bankrupt, liquidating an insurance company's gilts, and the insurance company failing Solvency II tests is a bad outcome for that insurance company. So I absolutely understand why there's a commercial rationale for that. And so we are seeing a variety of people choose that as the best and most transparent option, in that they know exactly what their margin is and they know exactly where it is.
In terms of the net omnibus, presumably if you've got a client in the net omnibus regime, you're still taking gross margin from them.
Yeah, still take gross margin, because me as a broker, I'm facing that client, and I need that margin to offset the capital associated with that product or that portfolio, and so I take the gross margin associated with that, and I hold the difference between net and gross in a segregated account. I can't use that money. That money goes out to a variety of client money banks, none of which are Morgan Stanley affiliates, and so that is about as safe as I can make that money from a cash perspective.
So I was having a conversation with a large institution only today, and just asking them whether they had actually closed any broker relationships in the last year based around those particular concerns. And they had. And I think this is this is increasingly this level of accountability and making sure, to your point, Andy, making sure my money is absolutely safe. It's going back to managing your risk, choosing the people that you work with in order to be able to do that, and making sure that you're putting yourself in the best position possible with the assets that you have.
So before I hand over just to Philippe to wrap up, I just want to review the final poll question. The question was, how do you manage pre-trade risk today? And we had 56% with a combination of fat finger checks and per day limits, and 22% on real-time portfolio margining, which clearly is what we've been talking about today. So, and then the 22% also on the first option of fat finger checks with per day limits, but also with some netting capability. So Philippe, just to conclude, reflecting on that, it seems that there is this evolution movement towards real-time cross-asset portfolio margining. How far off are we today, and what's your message to people listening?
Well, my message is I think that it's something which is available in the market today. You could be doing cross-margining, and together with cross-margining, other advanced risk models, as margining itself is not sufficient enough, in our view, to represent the risk of a client. And when looking at client portfolios in real time, you get a better view of your client, which is knowing your client and being able to service your client better, thereby building a better brokerage. I think that's key in the market, in the trend in the market, and the trend that whatever was offered T+1 previously is something that is going to be offered in real time, pre-order, in the very near future.
Thank you very much. And before we close out, I just want to thank the panel for joining us today, and thank you very much for listening.